Welcome. My name is Lorraine Gilbert, CEO of WealthWise Financial, and today is Thursday, October 30th, and we are continuing our monthly webinar series. Today, we're talking about understanding your 401k. And many people, most people, have a 401k at their place of employment. And because of that, we wanted to give an overview for you to understand more about how to make the most of your retirement plan. And with that today, I have Chris Dinterman, who is our retirement plan consultant, and he is going to give the presentation. We also have John Milliken, our Director of Investment Strategies, here as well. But today we're going to have Chris present to us on understanding your 401k. So with that, Chris, I'm going to turn it over to you.
All right. Thanks, Lorraine. And can everyone see that?
Yes. You just might want to make it full page so we can see it on the full page.
Oh, yeah. Let me do that. Get rid of this. Full screen. There we go. Better?
Yes.
All right. So as Lorraine mentioned, today we're just going to go over a high-level review of kind of what a 401k plan is, who can participate in your 401k plan normally, why would you want to contribute to a 401k, how do you contribute, and when can you get your money out, and then some final tips and takeaways on why this is an added benefit given to you by your employer. So with that being said, let's just start with what is a 401k plan. A 401k plan, again, is an employer-sponsored plan. It's sponsored by your company you work for retirement savings. The plan allows employees to contribute a portion of their paycheck into an account that grows tax deferred. Now, sometimes the employer contributes as well, often making matching contributions. So contributions to a traditional 401k are also made with pre-tax dollars, which is lowering your current taxable income, but then taxed in retirement when you take distributions out of the plan. Also, there's Roth contributions that you can make into a 401k, and they're made with after-tax dollars, providing tax-free withdrawals in retirement on both the money you contributed and the earnings on those contributions. So who can contribute to a 401k? Employees, and sometimes the employer will also make contributions. Now, there are usually minimum requirements for employees to be eligible, though, to contribute. For example, a standard plan might have 21 years of age and a 1 year of service requirement before you'd be eligible to participate and save money into the plan. It could be less. Some plans don't have an age requirement. Some plans even have a lower service requirement. You might be eligible immediately to join the plan and start saving. Also, some plans exclude certain people from being eligible. Those groups include non-resident aliens, union employees, and part-time or leased employees. Now, there are some special rules that changed with the first Secure Act that do allow what we call long-term part-time employees that have been working over 500 hours a year for 3 consecutive years to actually be included even if the plan excludes part-timers. So there are some exceptions to these rules.
And sometimes the reason that union employees are not included is that they have their own retirement system specifically for those.
Right. They're
people.
usually under collective bargaining, and a lot of times they might have their own pension plan or an alternative plan to the 401k. So why contribute to this benefit that your employer is offering you? For a couple reasons. You know, tax savings would be the first one that comes to mind. Basically, by making pre-tax contributions, you're keeping more of your earned income because you're paying less overall taxes. Secondly, tax-deferred growth. So whenever you invest and that growth can grow without paying taxes on the earnings every single year, it allows compounding to go faster, so it grows faster compared to a taxable account. Normally also in a 401k plan, you have less expensive investment products or options to invest your money in, or share classes, if they're mutual funds inside the 401k, than you would have in your own individual IRA. The reasons for this are basically economies of scale. So compared to having just one individual investing money, having a whole company investing money, all the employees, pulling their assets into one plan means the assets are a lot larger than what an individual account might look like. That allows you to qualify for cheaper and cheaper share classes on the mutual funds. Another advantage is dollar cost averaging. A lot of people don't think about this, but when you set it up to automatically come out of each pay period, the market timing is not as important when you're putting in the same amount on a regular basis. In other words, whether it be monthly, whether it be twice a month, whether it be every other week, your pay period is investing at each pay cycle as the dollars are withheld from your paycheck. And that kind of evens out, averages out. You're not buying in at the very low, but you're not buying in at the very high, which is good. It minimizes some of the risk of market timing. Also, you're getting professional investment management. So you get two layers of investment management by investing in your 401k. One is by the actual investment companies that offer the underlying mutual funds that are available for you to pick from inside your 401k. Those mutual funds are managed by a professional management team. But also you get a second layer from people like us at at WealthWise Financial Services, because we're also then looking at those investments that are offered in your plan to make sure you're getting best of class and that they're performing consistently as required. And then finally, how much can you put in? Well, this year in 2025, the Internal Revenue Code limits IRAs to just $7,000, or if you're over 50, $8,000 a year. A 401k, the limits are much, much higher. As you can see, for a 401k, for you to contribute to your 401k, you can go as high as $23,500 in 2025. Or if you're over 50, there's a catch-up provision that allows you to go as high as 31,000 this
I
year.
want to add a couple of things here too, Chris, which this is great. I would add that, you really want to contribute to a retirement plan if you have one, because people need to be saving for retirement. So it makes it very easy to sign up. And as that compounds and grows, eventually you'll have enough money to hopefully retire. And so we know that Americans are underfunded for retirement in general. So definitely a strong reason to use that. Another thing I want to point out is the expenses are not always, of course, lower in a 401k plan. And it just depends. So looking at that, certainly you want to contribute to your 401k plan because you're getting pre-tax dollars or even Roth contributions in your plan. But you can request to ask about how much it actually is costing, and you can analyze that as well.
Great, thanks. So now that we looked at why contribute, some of the advantages of contributing to your 401k, let's look at how you would contribute. So normally, it's required that you enroll and send in your payroll deferral. So first, you need to check if you're eligible with your employer to make sure that you're meeting the requirements of the plan to be able to defer some of your income into the plan. So do you meet the requirements set by your employer? Next, you would need to enroll. Now, enrollment can come in a bunch of different forms, but today, normally most enrollments can be done very easily online with your current record keeper on your plan. And what they ask for is just some personal basic information to verify that you are who you say you are. They usually have that information ahead of time provided by your HR department at your employer from your company. Secondly, they're going to ask you to set up beneficiaries. So if something happens to you, they know who these assets in your retirement plan should go to. And then finally, you have to pick a salary deferral amount. How much are you able to save? How much would you like to save from each pay period? And that normally can be either elected as a percentage or a dollar amount. Next, you might be requested to make an investment selection. Now, you can make investment selections and pick which of the individual investments and what percentages of your salary deferral you want to go into each to build your own portfolio inside your retirement, your 401k plan. Or if you don't elect any investments, there are what are called qualified default investment alternatives, QDIAs for short. And this is what happens if you don't make any investment elections and you don't really know what investments at the time you want to pick from what's available. It'll automatically default into normally what's called a target date fund or a model allocation. And the reason this is, these are considered one-stop shops. They're very diversified. It's kind of what people call a fund of funds. You're investing in one fund, and that fund invests in multiple underlying funds covering a bunch of different asset classes. The second thing that these do that are slightly different in picking individual mutual funds inside your plan is that as you get closer towards retirement, they're selected based on your number of years and age to retirement. And as you get older and closer towards your retirement date, your normal retirement date, they change the allocation in the underlying asset classes to become more and more conservative as you get to and through retirement. So again, that's why they're considered a one-stop shop. You get diversification and you get automatic rebalancing as you get older towards retirement to get more conservative. So let's look at when. Now we've talked about how to get into the plan, who's eligible, and how to make contributions, and a little bit about investments. But a lot of people's concern is, well, if I put money in, when can I get my money out? So there's lots of reasons. Obviously, normal retirement age, because this is a retirement plan. When you hit normal retirement age, you can take a distribution. It's a distributable event. Separation from service also allows you to take money out of the plan. Now, if you are under 59 and a half when you separate service, there are taxes and penalties if you take the money out as like a lump sum distribution. Most people, if they change employers and separate service and start a job somewhere else, they'd like to look at rolling the money over. Either they roll it over into their new employer's plan as a direct rollover, so there's no penalties, no taxes withheld. Or you can also roll it into an individual retirement account or an IRA, and there would also be no penalties, no taxes. It continues growing tax deferred until you would take it out during your regular retirement. Now, a couple other things, disability, obviously, death as well. Your beneficiary will be able to get the money out of the plan if something happens to you. Some plans also allow what are called in-service withdrawals. Now, this would be for only eligible if you're over the age of 59 and a half and still working. Also, financial hardships. Plans allow people to take money out if they have a financial hardship that involves things like medical expenses, keeping their home, things like that, as well as loans. Plans also can allow you to borrow money out of the plan and then pay yourself back into your account plus some interest. So there are ways to get money out of the plan, but the real purpose of the plan is saving for retirement. So if you can avoid it, it's best to leave the money in there accumulating into retirement so that you have a better, more comfortable retirement. Let me move to the next slide.
The one thing I'll add here is that sometimes in-service withdrawals have a different age on the plan. So we always want to check with the plan to see what that age is for an in-service withdrawals. And there are many reasons people want to do that. They may want it professionally managed by an advisor who is advising them on how to invest that money. So there are different reasons for doing that and rolling it over that way. And you'll want to check with your plan on that specific age.
Right. The bottom three are optional for plans to elect. They can elect to have in-service, they can elect financial hardships, they can elect to allow loans, but they don't have to. The top four are mandatory. So the top four you're always going to have. The bottom three are going to be up to your employer and what they elected for their particular plan. Great follow-up. Lastly, let's look at some eight final tips and takeaways. So we want to thank you for joining today and wrap it up here with these 8 things to think about when saving for retirement in a 401k plan. First, start early and contribute regularly. So time is your greatest asset in a 401k saving for retirement. Even small contributions over time can grow significantly when we're looking at possible decades due to compounding interest. So aim to contribute consistently, and even if you start small, it's better the earlier you start, even if it's a little bit of money, it pays huge dividends at the end. Also, maximize your employer matching contributions. A lot of plans, the employers will match your contributions up to a certain percentage. If your employer does offer a match, contribute at least enough to capture the full match. It's essentially free money that can be a significant boost to your retirement savings. Next, understand your investment options. Take time to review the funds that are available inside your 401k plan. Diversify your investments based on your own risk tolerance and retirement timeline. And you can always look for financial professionals for help with making those decisions. It's recommended that you increase your contributions over time. As your income grows incrementally, you should increase your contribution rate. A standard that we see now, and sometimes it's set up automatically, is a 1 to 2% annual increase in contributions. This can be a big difference without feeling overwhelming. A lot of new plans, if you're a new 401k plan now, two things are required by you. One, everyone is automatically enrolled, and two, you're automatically increased 1% a year up until a designated percentage. So those things are now required based on Secure Act 2.0 for brand new 401ks. In other words, new companies that open new retirement plans have to have those incremental um, annual increases in those contributions. Another thing you can think about is taking advantage of the tax benefits. Again, contributions to a traditional 401k reduce your taxable income now, while Roth 401k options offer tax-free withdrawals in retirement. So choose the option that aligns best with your current and future tax situation. So for instance, if your tax situation stays the same and you're paying 30% now and you're going to be paying 30% in retirement when you're taking distributions, then it doesn't really make much difference. You're going to end up with the same take home when you take money out of the plan, whether you're doing Roth or you're doing pre-tax contributions. However, if your taxable income rate is going to go up in retirement, which we never know what legislation is going to pass which way. Taxes tend to over time go up, it seems, and they very seldom go down. But if you're paying more taxes in retirement than you would be while you're working, then a Roth would be something you would want to consider. Also review and rebalance periodically. Check your 401k at least annually to ensure your investments align with your goals and risk tolerance. Rebalancing your portfolio can maintain your desired asset allocation. And what that means is basically, even though you might be allocating your portfolio 60% into stocks and 40% in the bonds, if the stocks are doing a lot better over time than the bonds and it's growing faster, your percentage then starts to get out of whack, where you could end up being 80% of your assets in stock and only 20 in bonds because of faster growth on one side or the other. So again, it's recommended at least annually to look to make sure you rebalance and keep with the risk tolerance that you have that's acceptable to you. Also avoid early withdrawals. We mentioned this earlier. This is set up to help you get to a retirement on time. Withdrawing funds before 59 and a half also often incurs penalties and taxes. Plus, again, it derails your long-term growth and your goals. It sets your goals back. So you might have to work longer, or you might have to save more when you get closer towards retirement. So explore other options first, like emergency savings, before tapping into the assets in your 401k. And then lastly, seek professional guidance if you need it. There are lots of tools out there that are available from your record keeper, and there's a lot of financial advice software that's available. But sometimes, again, reaching out to a financial advisor in person to tailor your 401k plan for your unique retirement goals is a great way to go. So by actively engaging with your 401k, you're taking a critical step towards a secure retirement. So start today, stay consistent, and let your savings work for you over time. And with that, I want to thank you all for attending.
Great.
And
Well, Chris,
yeah,
let's talk about a few other things. If you'll take the
yeah.
presentation down
Mhm.
so that we can just have a conversation.
Yep.
I think a few points that are worth a little bit more conversation. One would be the Roth contribution. So
Mhm.
for a lot of people, you may have been contributing to your 401k plan for years, and you may have accumulated a nice balance that's all pre-tax dollars. And so we're talking a lot to our clients about adding that Roth component, making contributions in there, building up. And many of those people are not eligible to contribute to a Roth outside of a 401k because of income uh, caps for contributing to a Roth IRA. But in your 401k, you don't have the income cap. Anybody that has the 401k with a Roth bucket in it, you're eligible to contribute to that. So consider balancing out your contributions. If you're earlier in your career, and not making as much money now, um, you know, so that's another reason why somebody early in the career, not making much money, you may want to contribute to Roth because you don't need the tax benefit. And then as you're making more money, then you switch to pre-tax. And then later also think about, wait, adding the Roth component again because you want to build a Roth bucket. Because when you retire, all the money coming out of that pre-tax bucket is going to be taxable. And not only that, you're going to have a required minimum distribution starting at age 73, where you have to take money out of pre-tax. And a Roth, no age. You can leave it in as long as you want without required minimum distribution. So a lot of reasons to think about that Roth bucket and making those contributions for your 401k.
And I can add a couple
Go
more
ahead.
reasons for the Roth. And I agree 100% with what Lorraine mentioned. A couple other things to consider if you're close to retirement and you start making Roth contributions, there is another caveat to Roth that you have to have it. If you're just starting Roth, you have to have it for at least 5 years, regardless of your age. If you open a new Roth, there's a 5-year requirement before you take it out, because then it could run into penalties regardless of your age. And then secondly, the flexibility in retirement. So again, Lorraine mentioned this, a Roth does not have any required minimum distributions. So that gives you a lot of flexibility with assets you can leave to heirs as well and beneficiaries, that they have a tax-free distribution if something happens to you later, that they can take that money and not worry about the tax penalties, no matter how large the Roth portion of your retirement is. It also gives you flexibility when it comes to financial planning in retirement, because a lot of people, they'll be pushing up to that where it might affect their Social Security income. Well, the Roth doesn't, right? Because it's not taxed. So there's ways to play with after tax and pre-tax to kind of play with how you're taking distributions in retirement to help you make sure you get the most benefit you can possibly get. So
Absolutely.
good
So that
points
was
there.
one topic I wanted to talk about. Another one is catch up and the super catch up. So that we now have the super catch up. Can you go over how that works?
Yeah, so the super catch-up is something that's brand new. Secure Act 2.0 added a super catch-up. Now it's a window. It's for people that are between the ages of 60 and 63 only, but it allows you, if your plan has an over 50 catch-up, it allows you to actually do more. And it's up to 150% of the normal 50 and over catch-up, or $10,000, whichever is greater. And for this year, the catch up, it ends up being that the 150% actually comes out to be more. So that's what it is this year. And I'm trying to remember the exact number off the top of my head. I didn't keep the slide open. I should have kept the slide open. Let me tell you in 2 seconds here. It is for, so if you are, again, it's 11,250 if you are meeting 2 criteria. Again, the first one being you have to be 60 this year, but less than 64. So either 61, 60, 61, 62, or 63 before December 31st of this year. And then the second part is you have to already be contributing the max to be allowed to do that 11,250 additional catch-up. Now, the normal catch-up is only 7,500. So this is a lot more. 11,250 is a lot more. So two
So that's
requirements, 60,
exciting
63, and over 50.
because, and the whole concept there is that that is close to when you might retire. And you may need to catch up for when you were younger and you weren't able to contribute as much into the 401k. That was certainly me. When I was younger, I could not contribute as much as I could now. So that's, people think about taking advantage of that super catch up if you're eligible in that 60 to 63 range. Another topic I wanted to address is there are many clients who have a 401k with a publicly traded company where that public stock is available in their 401k. And it can be very tempting for a lot of employees who know the company, feel good about the company, and they want to put a lot of their stock in that company. And at times that can be really good. And at times it cannot be. And I have seen over the years of doing this, people lose a lot of their wealth in their 401k because they were so anchored to being invested in their company stock. And the rule of thumb, just in general in investing, is to not have more than 10% of your overall investable assets in any one stock. And so, especially if you are working for a publicly traded company where you have that stock in your 401k, you may have that same stock outside of your 401k. You may have either RSUs, restricted stock, or you may have stock options, or you may have an employee stock purchase plan. So there's like lots of ways you may be accumulating that stock. So I just want to warn people and give you an overall consider to mitigate how much of your 401k goes into that company stock. And rule of thumb might be, 10%. So any other thoughts that you have on that, Chris?
Yeah, I mean, I don't, people might not remember the Enron and WorldCom situation, but those people definitely had a lot of company stock in their retirement, and it immediately went away. So not great to have all your eggs in one basket. We would never recommend that. Another thing though to think about when you do have company stock in your retirement plan is, if something happens to your beneficiaries, they get a stepped up cost basis. So it's when you get a stepped up cost basis, if they turned around and sold those stocks, they don't have to pay the capital gains, all that growth over the years that was sitting there growing tax deferred in your plan. If it's left to a beneficiary, they might actually get that tax with the stepped up cost basis, not paying very much taxes on that stock if they sell it.
Well, yeah, you can use what's called net unrealized
Right.
appreciation, and we
Appreciation.
do that for clients. If you have any questions regarding stock in your 401k, we can certainly help you understand those nuances and how to take advantage of just that net unrealized appreciation with that portion of your 401k. So with that,
And
go ahead.
oh, sorry, I was going to add one thing.
Go ahead, John.
There's been a lot of research recently into target date funds, and we do a lot of deep analysis on target date funds when we consult with retirement plans. And in a lot of situations, target date is a great option for a lot of employees participating in one of these plans. But there are situations the research has found where they're not always great. And this is one thing that we would, encourage you to talk to us about. And one scenario where target date funds were found to be less effective is whenever you have a situation where there's a major market dislocation, let's say a big equity sell-off, a lot of target date funds follow a rule where the rule might be 5 years out from the date we start selling stock and buying fixed income. So what happens is if there's a big market sell-off, the rule of the target date fund after the market sell-off might continue to sell equity at low prices and buy fixed income at appreciated prices, which has been shown to have a detrimental effect on people's retirement. So if there is a situation where we do have a major market sell-off, we encourage you to talk to us about, what you're investing in elsewhere so that we can take a look at it and make sure that it's appropriate.
Really good points. That would be one of the reasons someone might want to consider moving out of a retirement plan, as they're getting closer to retirement, and have it be professionally managed. And that's certainly something that we can help people with. So to wrap it all up, thank you guys. Great thoughts on all of this. Is that we are here at WealthWise Financial to help you individually think about your retirement plan. And we also are here to help corporations and business owners with their corporate retirement plan. So whether it's at the corporate level and we're working with plan sponsors, or the employee level and we're working with participants, either way, we hope that you contact us at wealthwisefinancial.com. Thank you for joining us.